go back. Run my previous problem in reverse. I put the corporate tax on. Here's K bar. With the tax, I go K tax. Go to here. The loss to workers is this area here. What happens if you do that same effective tax on K, but do it by taxing only one of the underlying capital inputs? What's the difference? Anybody got an idea? Well, if you're still going to have the same effective tax rate, you still got to move up this much, but you're also going to shift this curve up, right? Because we're going to produce capital less efficiently than we used to. Capital is going to be elastically supplied now, but elastically supplied at a higher cost. That is, the real cost of capital is going to be higher than it used to be, which means not only are workers going to lose this rectangle like they normally would and lose this triangle like they normally would, there's going to be an additional loss. So having an untaxed sector is not going to be the savior for workers, given an amount of the overall tax being raised. It actually means that the loss to workers is going to be even bigger relative to the amount collected by the government, right? Because it's going to mean that there's an additional distortion. That is, this supply curve is going to shift up. It's going to cost more to produce capital than it used to. A given amount of the capital aggregate is now going to cost more than it did in the past. So like, let's say they're each 50% of the capital stock. Having a 20% tax on half the capital stock is probably going to be worse than having a 10% tax on all the capital stock, because of this additional cost effect. It's going to make capital more expensive to produce. So not only is that all that 10% effective tax rate passed on to workers, and workers lose the triangle from having less capital, they also would lose the inefficiency now generated by having capital produced in a non-cost minimizing way. We'd have too much K2 and too little K1. Which would shift that supply of capital curve upward in terms of the aggregate capital stock. Yes?
So just trying to relate figure with the one you have over there. So is there a rho plus delta that's beneath the...
Well, it's not really rho plus delta anymore, right? Because you're no longer transforming investment into output as efficiently as you were before. It's like you became less productive, right? It's like the return on capital is measured by like the rate of return would be the same. That is, the delta, rho plus delta would still work, but the price of capital goods relative to consumption goods would be higher now, because you'd be producing capital goods in this inefficient way, right? That is, you could still produce 1 unit of K1 by giving up 1 unit of consumption, and you could still produce 1 unit of K2 by giving up 1 unit of consumption. But the way in which those are being combined to produce the capital aggregate is going to be inefficient now. It's as if you have a worse technology. It's more like a reduction in A in our previous world. It's like we've just made capital less productive than it used to be. Any amount of foregone consumption doesn't generate as much additional productive capacity as it used to, because we're misallocating how we use that foregone consumption. That's the way to think about it. It's more like a change in A. It's more like that production technology has been distorted.